Hi, everybody. This is Sonal Mahida with the Intentional Endowments Network. Thanks so much for joining us for this webinar. When we asked registrants what they wanted to learn during this webinar, you came back with quite a bit of feedback, which was really helpful for us. Next slide, please. What we heard from registrants was that they wanted to learn more about the basics of what proxy voting is, the mechanics of how it works, understanding how it can work with indirect holdings as well as commingled funds, the trends and what happened this year in the 2016 proxy voting season, and then also understanding how much resources it takes and what are the different ways to structure this. Next slide, please. We're going to end with a moderated Q&A. Please send any questions that you have via the chat function, and we'll integrate them into the Q&A at the very end. Next slide, please. To give you some context, there's a number of different ways to address ESG factors during the investment decision-making process. Proxy voting, engagement, and divestment are three ways that investors can address environmental, social, and governance issues after ownership or post-investment. Today we're going to focus mostly on proxy voting, although it's impossible to kind of isolate proxy voting from the different engagement activities and strategies. Next slide. There are a number of methods for engagement, and as you can see here, proxy voting is part of quiet dialogue and more on that end of the spectrum, but we just want to give you a context of all the other different tools that are available for you. Next slide. So what exactly is proxy voting, and why does it matter to investors? Well, as a shareholder of a company, especially in the equity size, you're a partial owner. And as a shareholder, you can weigh in on company decisions. There are a number of voting issues that are raised at the annual general meetings, or AGMs, of public companies. Most of these AGMs take place in the second quarter, which leads to us to call this time the proxy season. Issues that are put forth at the AGMs are done so by both management and investors. So oftentimes be a number of management proposals that need investor approval for regulatory or listing purposes. For example, if a company is on the New York Stock Exchange and they want to issue new stock that needs to have shareholder approval, all states in the U.S. require companies to get shareholder approval for the election of their board of directors, different stock option plans, and ratification of an auditor also need shareholder approval. Any investor that has at least $2,000 worth of stock continuously for at least 1 year may also file a proposal at the company. Next slide, please. So how have sustainability and ESG issues come to intersect with proxy voting? Well, over the years, U.S. investors have increasingly raised environmental, social, and governance issues with companies at their annual meetings. A number of these have been firms that focus specifically on ESG issues, and there's also been institutional investors such as pension funds that have gotten involved. A lot of these firms and investors see this as part of their fiduciary duty as long-term investors. They want to ensure companies are addressing these issues and any risks and opportunities associated with them. For example, having human rights policy in place is not just a nice thing to have. It can help a company avoid actions that could lead to reputational risk. Now, on this slide, you see a number of examples of issues that are raised through shareholder resolutions. Again, these are areas where a lot of investors are seeing risks or have concerns. Next slide, please. This slide is going to show you the types of requests that are made by shareholders. The SEC has specific rules around the requests that can be made in shareholder resolutions. So you're going to see most of the shareholder resolutions that you will vote on in your proxy voting are going to be asking a company to report on a specific topic or adopt policies around an ESG topic. I wanted to point out here, don't underestimate the power of disclosure. To paraphrase Justice Brandeis, sunlight is the best disinfectant. And as everybody who's gone to business school or taken business class learns, you can't manage what you don't measure. So that's a lot of these issues can still have a lot of impact to a company and make sure that there are concerns and risks that are being raised internally. Next slide. So does proxy voting work? Does it matter? Does it have an impact? Proxy voting turns out to be quite a good engagement tool that can have impactful results when it comes to environmental, social, and governance issues. Our speakers are going to go into more discussion about examples of what actions have come out from proxy voting or shareholder resolutions and where there are higher votes. What I wanted to talk a little bit about was what I consider the ripple effect. As some of these issues are getting increasingly high votes, they're influencing companies across an industry to act on proposals and engagements. Companies really want to avoid having these proposals on their ballot, their AGMs. They want to lead the conversation there. So what's happening now is when they see a resolution get a high vote, when a peer company gets it, they either want to resolve the dialogue and come up with some agreed actions with the investor that filed the proposal, or they'll go and challenge the resolutions at the SEC. But what we're seeing over the past few years is companies are responding to this investor interest. They're engaging more in stakeholder dialogue, which is leading them to develop more corporate policies around environmental, social issues and improving their transparency. There's been an increasing number of withdrawals that have happened when a resolution is filed. And again, that's showing that companies are more likely to sit down with investors and engage and have a dialogue around this. When a proposal is withdrawn, the company needs to take action. There's oftentimes a written agreement between the investor who's put the proposal forward and the company. And if the company doesn't follow through on what they've agreed action, they'll receive the proposal the next year. So it's a bit of a carrot and the stick approach. So by being active shareholders, you can really help support these issues and change corporate behavior and hold these companies accountable for their social and environmental impacts. When it comes to proxy voting, it's important to be aware that this is happening on behalf of your endowment already. Someone is out there voting your proxies. So this isn't a new action. It's much more about reclaiming and leveraging the voice that you have at companies. Next slide. As a result, it's really important to discuss and share your views on these issues with investment managers. And here we've pulled some questions. There's a number of different resources out there that you can see, and we can share these slides with the attendees afterwards. But the questions you can talk to your investment managers about really fall into three categories: their approach, their policies and practices. So what have they structured and what have you put into place to address these issues? The structure, the governance, who's voting the proxies, are they able to adjust their voting so that they can address specific issues in certain ways that you would like them to, and then what are the outcomes and results? You know, where does their voting fall overall? We know of at least one endowment that got together with investors in a commingled fund to request their manager support certain resolutions. So this is possible to do regardless of whether or not you're in commingled funds. Next slide. So I'm going to turn it over to Heidi now and let her give a discussion about what she saw happening in this proxy voting season and the various trends.
All right, Sonal, thanks a lot. And I'm going to dive right into the issues and talk about some of the trends, what we've seen, and the outcomes this year, and give a little bit of more specific impact analysis on a couple of different issues. Next slide. All right, so here what you can see, as Sonal has mentioned, the annual meeting season, which is at its most intense for companies in the spring, really serves as a key barometer of sort of investor sentiment about a whole variety of corporate reforms, both the kinds of requests that are being made and then how they're received by investors at large when you look at the votes. So I'm going to talk about some of the issues that are raised in proposals and show you how this has changed. If you look at all social and environmental proposals, excluding corporate governance, shows that the total number of resolutions filed did drop back a little bit this year to about 420, down from an all-time high of about 460 last year. The total, and if you break that out by the types of issues, the total number of environmental and sustainability proposals has dropped as well. And on social proposals, it's stayed relatively constant. In that category, the most prominent and the biggest subsegment is political activity. Next slide. So here you can see that even though the total number of filed proposals has dropped back a little, the number going to votes has actually continued to climb. And Sonal said that the number of withdrawn proposals has been on the increase, but in the last year, in the last 2 years, it's actually dropped back a little bit, dropped back some last year, and it's dropped back even more this year. But the total that will go to votes will be about 240 this year. There's question marks about 20 of them. Some of them are pending for the fall and may still be withdrawn or omitted. So when we talk about omitted, omitted is a resolution that was filed but then excluded from the proxy statement after a successful company challenge, which is lodged at the Securities and Exchange Commission under provisions of the shareholder proposal rule. This proportion, though, has fallen to only about 10% of the filings this year, which is an historic low. So a lot of the action about shareholder resolutions can come well before a company even publishes its proxy statement. This is where we talk about the withdrawals. Since proponents may negotiate about the issue, and the proponents can prompt more disclosure or action triggering these withdrawals, and that's really seen as a success in many cases. But as I said, in the last 3 years, we've seen a drop in the number of proposals withdrawn, and I've been speculating with folks about why this may be. It may be because proponents are now asking for much more difficult things, and it's harder to come to agreement. It could also be because the companies who now have these proposals are just more recalcitrant and unwilling to change. Next slide. So here you can, I've broken out the average levels of support for the 3 big categories of sustainability, which combines both environmental and social issues and the environment. So votes for all these average about 21%. That's about twice what it was 10 years or so ago. And it doesn't sound like a lot, but 20% is a threshold that management and boards of directors really pays attention to. It's a significant minority voice that has to be addressed, and companies really pay the price if they don't. These votes have been increasing for many years as more investors, including mutual funds, have started to pay closer attention to proxy voting and to vote for proposals. Until 2016, environmental proposals have tended to earn less support than sustainability disclosure, mainly given the high levels of support for political spending transparency. The environmental ones have also earned a little bit less than social, and political spending is I put in the social category. But this is changing, as you can see on the chart, and environmental proposals are now on track to earn about 23% this year. So next slide. So here, this breaks out the environmental topics that are raised. This is on proposals filed. And climate change is the biggest issue, bar none, for environmental and sustainability proposals filed, and there were 93 proposals this year. Some of those counted here for sustainability reporting explicitly reference climate change, but in the context of other issues as well, like labor and human rights. So there's basically twice as many climate proposals this year as there were back in 2010 when there were only 50. Next slide. So here, taking a closer look at a few of the environmental subcategories and the support levels show that support for climate change proposals has reached an all-time high this year of nearly 25%. So sustainability reporting votes have fallen if you include not only reporting but other sustainability resolutions, and environmental management proposals earned about 23%. Next slide. So I wanted to pull out for you some of the substance of the proposals this year on the environment, since that's a big concern for many on the call. Many shareholder resolutions have focused on how energy producers should mitigate climate risk, keeping more of their fossil fuel reserves in the ground to cut emissions and then work to transform themselves so they and the rest of society are less reliant on carbon-polluting fuels. So as we'll see further on, this most often is expressed in requests in shareholder proposals for carbon accounting, which is measuring and reporting on greenhouse gas emissions so they can be managed and reduced. This year, we also saw, though, a continued push for what's been termed a scenario analysis, for companies to explain how adapt their businesses to several different policy environments and how they will address the different types of risks and opportunities these pose. This is keyed to the 2 degrees Celsius warming limit that was agreed to at the Paris climate talks last year. So one type of climate and environmental proposal also relates to hydraulic fracturing and asks companies to explain in much greater detail how they are addressing the risks associated with this practice. This would be things like methane emissions from wellheads, greater contamination, other water contamination, and earthquakes. There was a new, pretty interesting wrinkle this year on this subject with a proposal to a company called Freeport-McMoRan, which is a big mining company, but has also recently acquired a bunch of oil and gas assets and extracting these in Los Angeles, which poses, as you can imagine, some pretty fraught issues when you're doing that in a highly dense urban area. And the proposal earned 22%, which is a pretty good vote for the first year. So not surprisingly, a lot of oil and gas companies have gotten these types of sort of climate disclosure proposals, but this year we also saw a big new focus on energy users, such as retail chains and others, addressing the demand side of the equation. This was also, this whole question of demand and supply was expressed in proposals to electric utilities and their big customers, and the proposals asked them to support the idea of distributed energy that comes from solar panels and wind turbines installed where businesses are located, and also talking about how utilities can incorporate this fast-growing approach to their business models instead of in central large power plants. So the focus on all of these is on practicalities and how you actually change. Next slide. So this takes a look at some of the most common environmental filings. You can see the most significant groups, as I've mentioned, are those that touch on within climate change. 20 proposals that this year ask for greenhouse gas emissions targets. And then there were another 12 proposals on methane emissions disclosure. A lot of that has to do with fracking. And as I mentioned as well, the campaign started last year to get companies to support the concept of distributed energy. Started with just 1 proposal last year, and there was a big jump to 12 this year. There were a bunch of other proposals, around a dozen, on renewables, asking companies to set targets for using those. This is renewable energy sources, and 6 about reporting on such targets. Again, measuring and managing and producing more disclosure. So what's pretty notable, and this is implicitly a success, is that there are a lot fewer broad sustainability reporting proposals now than in the past. Only 17 this year, down from a high of 39 back in 2010. And this is because most companies are now actually providing these reports, and those that don't really stand out. And the previous high votes have prompted the disclosure everybody was asking for. I think that's a real win. So now, as a result, investors are making their requests for information a lot more specific in their proposals. There were, as I mentioned, hydraulic fracturing. There are about half a dozen proposals on that, and about half a dozen on water risk as well. Next slide. And here are some of these are some of the sort of vote successes this year. We actually have seen 7 majority votes for both social and environmental issues. This slide just looks at the environmental ones. Not mentioned here are 5 that related to corporate election spending and also diversity both within the workplace and on boards. Those typically have earned more than environmental proposals, but I've broken out here the environmental ones given the big increase in those votes. To put these figures in context, since 2010, only 25 environmental and social resolutions opposed by management have earned majority votes. So having just 7 in 1 year get majorities is a really big deal. A specific thing of note was this very high vote at Occidental on a climate change resolution. To see such a really high vote, 49% at an oil major, is remarkable, and it seems like, to me, it's a real true shift in the terms of the debate at these companies in shareholder engagement. This result on a climate proposal has been exceeded only twice before. There was a 53% vote back in 2010 at Massey Energy. As some of you may recall, that was the coal company responsible for the Upper Big Branch mine disaster that killed 29 people, and the CEO is now headed for jail, although potentially may not go there. appeals. But the other really high vote on a climate proposal was a vote that also this year on methane emissions, and it was at WPX Energy, a much smaller company than Occidental, which explores for oil and gas. And then finally, a really interesting note this year was a 60.8% vote at Claircore, which is a filtration company. There's been a long-running sustainability reporting request that the company said was just too expensive to implement in the past. But after the vote this year, the company's general counsel said the board of directors will consider very carefully how to proceed and to basically spend what we need to spend to produce what the investors want. So the bottom line in all of these is that with reports showing this level of support from investors at large, not just the shareholder activists, companies must respond. Companies generally say that if, I think I mentioned this before, if a resolution gets about 20%, it has to address the issue in some fashion. If they don't respond to votes approaching or exceeding 50%, their investors will really start to lose confidence in the company, affecting investor confidence at large and the way in which the company is valued in the stock market. You just can't ignore your investors if you want to stay in business for any length of time. So these types of votes really prompt action. Next slide. So I want to just quickly take a look at one other really big issue. We don't have time for everything. One of the enduring themes of proxy season and in this political season for the public at large is corporate political spending. So between 2010 and 2016, investors filed 787 shareholder resolutions about corporate political activity. This as you might imagine, reflects the widespread public attention to election spending and lobbying by companies. And in response to the investor pressure, an increasing number of companies have actually put in place formal board oversight and reporting mechanisms, and I'll talk about that in a minute. The vast majority, more than 80% of these proposals, have asked companies for more board oversight and disclosure of spending on both elections and or lobbying. Nearly all of the 350 proposals on elections have used a template from a group called the Center for Political Accountability that some of you may have encountered. It requests board oversight and data on both direct spending in political campaigns and indirect spending by other groups like trade associations. On lobbying, more of the disclosure proposals have actually been on lobbying than in election in the last couple of years. There have been more than 300 proposals on these in a campaign that's led by a social investing group, Walden Asset Management, as well as the union, the American Federation of State, County, and Municipal Employees. So investor support for the board oversight and disclosure of election spending reached an all-time high this year of 33%. Lobbying disclosure proposals get about 25%, a little bit less. And shareholder proponents and companies reach agreements about more disclosure and oversight, most commonly on election spending. There have been 106 withdrawn resolutions to date. Additional agreements then occur outside the corporate annual meeting season. This pushes them, they don't want to see a resolution, and they will come to an agreement. There also have been negotiated agreements on lobbying with 81 withdrawals there. But a real key stumbling block going forward remains this whole question of dark money and corporate influence that is not publicly discernible. This is the extent to which companies should report on their contributions to trade associations and other politically active nonprofit groups that are not required by law to disclose their donors. These groups, as I said, spend both on elections and lobbying. So next slide. This is my last slide. It talks about the impact of a political disclosure campaign. We have been at SI2 have been doing research on this subject since 2010, and this issue really provides a clear example of investor activism impact and how corporate behavior has changed. So since 2010, as I said, we have data on some key performance indicators. We've also recently been doing some research for the Center for Political Accountability, and it's what it calls the CPA-Zicklin Index, which issues each fall, and it tracks how companies are responding. We've done our own tracking, though, for a longer period of time, and the table here shows the substantial response to the resolutions. Many more companies now tell the public how they give. Twice as many have in place board oversight of such spending, which puts a brake on the potential misbehavior by employees to serve their own purposes. Twice as many also now explain how their lobbying processes work, although there's still a lot of room for improvement on lobbying disclosure, particularly at the state level where it's not required in many states. But on that point, last fall, Walmart, in response to a shareholder resolution, agreed to disclose state-by-state expenditures, which is likely to have a ripple effect, as Sonal had mentioned, throughout the country and enable greater tracking and accountability. So I think I'm going to close up there. There's a couple of other facts and figures here on dark money spending, but I'll basically it's increased, but there's still a lot of room for improvement. So I'm going to leave it there and let us move on to Laura.
Thanks, Heidi. So good afternoon, everyone, and thanks so much for the chance to share a little bit about the Nathan Cummings Foundation's thinking with respect to proxy voting. Because our approach to proxy voting and active ownership in general is really driven by the Foundation's organizational identity, I do want to take just a minute to talk a little bit about who the Foundation is and what we do. The Nathan Cummings Foundation, or NCF, is a private family foundation. We have a roughly $440 million endowment, and we strive to create a just, vibrant, sustainable, and democratic society. Specifically, we focus on two pressing and interconnected problems, which are climate change and inequality. And like a growing number of foundations, NCF really strives to use all of its assets to further its mission. This includes being an active owner, voting our proxies, and filing shareholder proposals on a range of environmental and social and governance issues with implications not just for our program areas, but also for long-term shareholder value. Over the last decade and a half, we've filed just exactly 200 shareholder proposals, and we voted literally thousands of proxies. Next slide, please. So why do we do all of this? Well, for us, there are really two main drivers. First and foremost, we see proxy voting as part of our fiduciary duty. Many of the issues to be voted on any given ballot have implications for long-term shareholder value, including many environmental, social, and governance proposals that are filed by a company's shareholders. For instance, there's a substantial body of research that unequivocally demonstrates that climate change poses material risks for publicly traded companies in certain industries. Likewise, as Heidi mentioned, there's a lot of evidence that political spending can have significant implications for a company, and really political spending is something that should be overseen by a company's board and ultimately disclosed to investors to allow them to consider how a company's responding to political spending, how it's overseeing its spending, and what their strategy is. So while climate change and political spending are clearly two of the most prominent social and environmental issues on which investors engage, they're not the only ones that have significant implications at times for long-term shareholder value. So from the perspective of a foundation that's really set up to exist in perpetuity, so set up to exist for forever, voting in favor of proposals that call for information on how companies are responding to long-term risks like climate change is really a no-brainer. The second driver for the foundation is our desire to use all of our assets and not just the 5% that we give away each year in the form of grants to further our mission. So for instance, the foundation is committed to addressing climate change, and for us, filing proposals and voting our proxies is a way to address the climate impacts of the companies we hold in our investment portfolio. And this really applies to any organization that's concerned about the impacts of climate change, even if you've chosen to divest from fossil fuels, which the Nathan Cummings Foundation has not done. There are other emitters in your portfolio. We are signatories to the Montreal Pledge, which requires you to do a carbon footprint of some portion of your investment portfolio. And so when we got our carbon footprint last year, 9 of our top 10 emitters were not fossil fuel companies. In fact, they were companies that were utilities or in the paper products industries. So as Justice Brandeis pointed out, a very long time ago now, if you hold a company's stock, one of the key ways to address your responsibility as a stockholder for the social and environmental impacts of a company's behavior is through being active and through voting your proxies. And I just, as sort of an aside, you'll note that I've included governance issues as among the issues that have implications for the Foundation's program areas. And it might not be immediately evident how governance issues can impact the program areas of a foundation that's focused on inequality and climate change. But governance issues really do have direct ties oftentimes to environmental and social issues, and a really good example of that would be the proxy access proposals that were filed by the New York City Comptroller's Office over the last 2 years. Many of the 75 companies that received those proposals were initially looked at because they lacked either gender or racial diversity or both on their boards of directors, or because they were operating in the fossil fuel industry and they needed to have some particular expertise on climate change that was potentially lacking on the board at the moment. So, I think it's really important to keep in mind that governance issues also have some really important implication oftentimes for environmental and social issues. Next slide, please. So, all of this Foundation's shareholder work, which includes our proxy voting, is governed by the shareholder activities guidelines that our board passed back in 2002. And those are really broad guidelines that really have given us a lot of flexibility to do what we need to do, both in terms of proxy voting and in terms of actually filing resolutions and directly engaging companies in other ways. So the guidelines stipulate that we will vote our proxies in line with our programmatic interests and our broader mission. And they also stipulate that the proxy voting process will be managed by staff. So it's actually managed by me. I'm the Director of Shareholder Activities. Our CEO and our board do provide oversight on an annual basis. They are given reports showing all of the votes that were cast by the Foundation in any given year. So every single proxy vote we cast, they get to look at in a summary form that really indicates what we were voting on and how we voted. So I mentioned that over the years we've literally voted thousands of proxies, and while the basic tenets that guide how we vote haven't changed, the mechanics of the process and how it's managed have definitely evolved over the years. When we first began to do this back in 2002, we voted all of our proxies in-house. So we used a free online platform, proxyvote.com, and supplemented that with ISS research and vote recommendations on each of the issues that we were faced with for all of the companies that we owned. And then we tracked internally in a huge, gigantic Excel spreadsheet how we actually cast our votes. So some of the benefits of that approach for us were that it was really good for building sort of internal knowledge about what shareholders were asking companies to do, and what were the reasonings behind those asks and why did companies oppose them, and what were some of the things we needed to be thinking about when we were actually voting those specific proposals. It was also something that, above and beyond the staff time, which was indeed substantial, the costs associated with that were sort of not particularly high. However, that approach did have some drawbacks, which is one of the reasons that we no longer utilize that approach. And for us, one of the big sort of cons associated with the in-house method for voting our proxies was that it was really, really time-consuming during proxy season. I would say that probably at the height of proxy season, so sort of late April into May, I was spending at least 2 full days a week sometimes voting proxies and entering them into our internal tracking spreadsheet for reporting back to our board at a later date. And the reporting and tracking process itself was also very cumbersome when we did it in-house. It was time-consuming. It wasn't sort of elegant, and it was very hard to sort of produce like an easy-to-read summary when we were doing the tracking internally ourselves. So I think probably about 5 years ago, so around 2011, we made a decision to have ISS, Institutional Shareholder Services, vote our proxies in accordance with a custom guideline that we worked with them to develop. And that guideline was in fact based on the prior guideline. It was probably about 14 plus pages of very detailed sort of here's how we vote on particular issues and what we'll consider. So we took the existing policy that we had drafted ourselves. We worked with ISS to sort of integrate that into a custom policy that they then used to vote all of our proxies for us. Some real benefits to that were that it freed up a ton of staff time, particularly during proxy season, which was great because we also file proposals, so we have a lot going on during proxy season already. The reporting was also really seamless and easy and clean. And it also allowed us to have really detailed control of every possible voting item if we wanted to. So there was a mechanism by which we could just go into our account and we could click a button and override a vote that Institutional Shareholder Services had cast for us according to our custom policy if we felt like they weren't interpreting our policy on that particular issue correctly. One major drawback to that issue was that it was quite expensive in terms of the actual external outlays of cash. So not only were we paying for all of the ISS research and vote recommendations, but we were also paying for the executing and reporting on the back end. So roughly probably 2 or 3 years ago, we realized that we could have our custodian, which is Amalgamated Bank, and that's just the custodian for the 10% of assets through which we do our active ownership work, so our proxy voting directly, and then our resolution filing are done through that account, which is both managed and custodied by Amalgamated Bank. So essentially, we realized that because they were our custodian, they would vote our proxies for a very minimal reporting fee. It's literally a couple $100. But it is done not according to a custom policy for the Nathan Cummings Foundation, rather it's done in line with the guidelines that govern Amalgamated Bank's Longview funds. However, we had worked with Amalgamated for quite a long time, and I spent a lot of time going over their guidelines and comparing them with the actual vote outcomes that it produced versus the vote outcomes that were produced under our custom policy, and I found that we really were sort of arriving at roughly the same vote outcomes. So we now have our proxies voted by our custodian in line with the guidelines governing the Longview funds. Some of the benefits of that, of course, have been that it continues to free up the staff time. So there's virtually no staff time required anymore except for pulling the reports and making sure that things look right. And it has very, very minimal costs. I would say there's been one sort of drawback to that has been we've really lost the ability to determine the way we vote on each individual item. However, we can override particular votes. There was an instance recently where I was really concerned that our shares were going to vote against a proposal that we had in fact filed. And that was a rather new proposal asking Chesapeake Energy to eliminate the use of reserve replacement ratios in its executive compensation plan. Essentially, they were incenting their executives to drill with those types of, I guess, I'm forgetting the words, but essentially they were incenting their executives to drill with those particular metrics. And I was really concerned our money would be voting against our own proposal. I talked with them. I did find out there is a way for us to override it, but it's a pretty involved process and not something that we could be able to do on a regular basis. So I think with that particular setup, that's the main drawback there. The other thing I want to note is that because we do use an OCIO to manage roughly 90% of our endowment, so everywhere where we're not filing shareholder proposals, we do have an ongoing focus on voting policies and practices of our underlying managers as well as our service providers. So in the past, we've, in a number of instances, successfully pushed for underlying managers to use the ISS benchmark policy, which, while not perfect, I think gets us a long way to where we want our managers to be at least. And then more recently, we've had a successful, and it continues to be ongoing, but a successful push around Vanguard and some of the other mutual funds. We worked with our grantee, the 50/50 Climate Project, to produce a scorecard on mutual fund votes on proxy access, and it really held up Vanguard, Fidelity, and JP Morgan as real laggards in terms of supporting a usable threshold for proxy access, so allowing investors to use a company's proxy to nominate directors. So the scorecard was released. It did get picked up and covered by the Financial Times and Forbes, and a few weeks later, Vanguard actually changed their vote on proxy access to support proxy access proposals with a 3% ownership mechanism. So that was another successful effort for us. We are continuing, though, to focus on Vanguard because they are the service providers for our employee sort of retirement fund, and so we do continue to have concerns about how they're voting, particularly on environmental and social issues, which they essentially don't support any of those, to my knowledge. Next slide, please. So I guess I want to just leave you with the message that your vote really does matter. I do have companies continue to use low levels of support to justify inaction. Unfortunately, in my experience, there are companies out there that even if a vote is approaching or very close to 20%, they don't care. They claim their investors don't care, and they have in fact asked me this year. I was talking with a company on disclosure of lobbying expenditures, and I asked them, what they were prepared to do about this, and they actually countered that would I withdraw my proposal because clearly their investors didn't care about this issue. It had gotten, low levels of support the previous year. So under our efforts, we were able to increase the support for the proposal by 50%, but I just found it sort of shocking that a company flat out told me their investors didn't care. I think the vote on that was something like 17 or 18% the prior time it was up for a vote. The other thing I would say is that, as Heidi sort of alluded to, there's been a number of important votes that have been really, really close lately. I sort of think we're approaching a tipping point. So this year there was a carbon asset risk proposal that Heidi mentioned at Occidental Petroleum. They got 48.99% support. There was a proposal on equal voting rights at News Corporation that went to a vote in the fall of 2015. That proposal, even though Rupert Murdoch, who runs the company, controls 40% of the vote, still got 49.5% of the investor vote. So, half a percentage point away at a company where 40% of the vote is automatically going with management. We also saw a request for disclosure of political spending at Duke Energy that got roughly 49%. That was, I think, 2 years ago. So these are all proposals that were filed by the Nathan Cummings Foundation in the last 2 or 3 years that have been less than 1%, often away from passage. And, majority votes do have a number of implications for companies. Even though these proposals are non-binding or precatory, there are, and I think Heidi touched on this as well, a number of sort of ramifications for our company that does choose to ignore, especially a majority-supported shareholder proposal. ISS, Institutional Shareholder Services, will now consider voting against or recommending a vote against certain directors if they ignore a majority-supported shareholder proposal or they don't address it in a way that's actually meaningful. It also does draw attention and scrutiny from other institutional investors. And frankly, I do think that most companies will implement a majority-supported shareholder proposal even when they have a history of not being very responsive to investor concerns at lower levels. So another example from the Nathan Cummings Foundation's work would be Oracle. We filed a proxy access proposal there. It got 56% last fall because they're on a slightly different schedule than most publicly traded companies. And even Oracle, which has a long history of being relatively unresponsive to investor concerns, has now implemented proxy access as a result of that majority vote. So your vote does matter. I guess I should hand it back to Sonal now for the Q&A.
So while we're waiting for questions to come through, this is Heidi again. I thought I'd just make one point. A lot of these really interesting, juicy issues started out as being very, very small vote proposals a few years ago, and as they've been seen by Wall Street analysts to be having much more sort of direct impact on how companies do run their companies and how their financial results turn out, the votes have increased. And there's now, I think we're seeing some convergence between the social and environmental and governance issues with the proxy access campaigns that Laura was talking about. Given the picking of the companies that were proposed, where the resolutions were proposed, and on average, those types of resolutions actually are getting majority votes, much more than 50%. and at this point, something like 230 companies have adopted proxy access. So when you're talking about elections to the board of directors, you're talking about the strategic sort of direction of the company and fundamentally changing, potentially, the way the companies do business. Now, some folks think this is not necessarily the case, but we will see the jury is out. The right has now been won at quite a few companies, and the next step in that sort of campaign will be sort of contested director elections, which I think you will see more of going forward, and that's a real focus of the 50-50 project that that Laura mentioned. And we're going to do SI2 will be doing a webinar next week, specifically looking at the utility sector and both sort of climate change, corporate governance, and political spending, sort of drawing connections between a lot of the issues raised in proxy season. So if anybody's interested in that, you can go to the IRRC Institute website and sign up for that webinar. It'll be on the 19th.
Great, thanks for that, Heidi. Heidi, I was wondering if you could talk a little bit about what you're seeing with some of your endowment clients, how prevalent are active proxy voting policies in place for endowments, and why you're seeing endowments are choosing to do engagement or make sure that they are more actively voting their proxies.
Well, some of the folks that get our research are the very largest endowed colleges and universities who actually have had proxy voting procedures in place for a really long time. Many of them started doing that in the early 1970s in response to protests about initially the Vietnam War and then South Africa. And then they've been chugging along ever since. And their approach is to basically convene a community sort of decision-making body. Usually it's a committee. They have faculty, some finance administration people usually, and students, and they debate over these issues. And there's a real sort of pedagogical component to it where those involved can really understand how these really complicated issues play out at particular companies, and they can learn how that it's really interesting for them, and they can do that at the same time as they meet their sort of fiduciary responsibilities as owners to weigh in on key issues that are addressing those companies. I'm not sure if that answered your question. I think that answers most of your question.
That's really helpful. Laura, you know, when you were talking, you alluded to having a look at kind of the resources that you're devoting to proxy voting. I was wondering if you have any other insights from the process that you went through on ways to take proxy voting with limited resources. You know, not all the endowments are huge and have staff to devote to this. And then if both Laura and Heidi, you guys can talk a little bit about ways to engage beside proxy voting that don't take up a lot of resources.
Sure. So,
Laura,
you know, one thing I would just say is that it may look complicated to somebody who's sort of grappling with how to do this for the first time, but particularly if you just pick a few issues that you really care about and, you know, definitely have, you know, potential long-term implications, term shareholder value, I think that you can pretty easily begin to vote proxies in a way that more closely aligns with your values by picking issues like climate change or diversity or human rights and making sure that as a sort of baseline, you're consistently voting in favor of shareholder proposals calling for reporting on these issues. I think the other thing I should say is that because these are precatory and because they're often disclosure requests, it's not as though, you know, you're forcing a company to take some action that could be sort of dramatically bad or even a little bit bad for the company in the short term. I mean, these are things that the companies need to be overseeing. There's not a ton of cost associated with taking information you really already need to be tracking and putting it on your website. So, you know, I think just having a very basic policy about issues you care about and making sure that you start there is a great way to get going.
I would just add the other thing is that you know, a lot of relatively smaller endowments may not have direct equity ownership, but they certainly have someone managing their money. And a really important focus is on sort of financial sector intermediaries. In other words, are your managers voting proxies? Do they have any policies? I've been to a lot of conferences, and the managers go and they say, oh, well, this is the hot new issue. How do we address this? But we actually don't get that many questions from our clients. If we did, we'd respond, and then that would have important implications for what we do. So I think the takeaway on that is ask your clients, or rather ask your managers. They will respond to you as their client. And the other thing is that these are not these issues vary company by company. One disclosure request at one company may make a lot of sense, but at another company, they may receive a resolution and it may actually not make sense to support that proposal because they may already be doing something or respond fairly robustly. So those kind of sort of gray areas are important to pay attention to. That's often something that gets down into the weeds a little bit, but it's important, and it also sort of illustrates how complicated all this can be in practice. I don't mean to sort of counter necessarily what Laura's saying, but I do think it can be really interesting, to put it that way.
Right. Although I do think that most companies that have really done a good job of substantially implementing a request will have challenged on that basis at the Securities and Exchange Commission, and so there's not tons of risk that you're going to support something that the company's already doing a great job of reporting on, because frankly most of the time it won't end up getting through the exclusion process of the SEC.
And that's fair enough. That's true.
Yeah. As a follow-up question, how can endowments with limited resources choose which companies and issues to engage on? Do you guys have any recommendations? Laura, do you want to talk a little bit about your process of how you guys decide what you're going to do each season?
Right. So, I mean, for us, obviously, we vote, or we now have our manager vote all of our proxies. But with respect to actually engaging in terms of both writing letters to companies and then potentially filing shareholder resolutions, all of that is guided by dual criteria. The first is that it should have implications, potential implications at least, for long-term shareholder value, so something we think the company should be looking at. And the second is that it aligns in some way with our programmatic mission. So again, because we fund on inequality and on climate change, those are areas where you see the foundation being particularly active. So climate change has been a big area of focus for us, as has corporate political spending and lobbying, because those have such sort of strong linkages to our program areas and things that we care about as a philanthropic organization.
Great, thanks for that. Heidi, did you have anything to add?
No, I don't really.
Okay, great. Thanks for that. Laura, you were talking a little bit about your work with Vanguard, as a mutual fund, and I was wondering if you have any thoughts on how you can implement engagement for an endowment if most of their holdings are in mutual funds. What insights do you have from kind of your conversation with them? And Heidi, if you have anything to add.
So, I mean, first of all, I would say that it's so important for, I guess echoing what Heidi said, it's so important for mutual funds to be hearing these questions from their clients, because actually changing the way that a mutual fund like Vanguard or Fidelity votes on an issue has huge implications and is actually a much bigger impact than just changing the way you yourself vote, because it's everyone's money that's getting voted that way. The other thing I would say is that if you're not directly invested in a company and you don't have standing to vote or file shareholder proposals, you can still join in, sign-on letters that are often put together by organizations like the Investor Network on Climate Risk or Ceres, and you can still ask companies questions. And I think that that's an important way also to begin to learn about the issues that shareholders focus on.
Yeah, and on that point, I think you might be pleasantly surprised. Companies actually can view this process as a way to discover what's going on. For instance, the head of and interesting things that they're going to have to address. It's, as I said earlier at the beginning of my talk, this is really a barometer of investor opinion. It's an early warning sign, too, about issues that companies may have to deal with. So, for instance, well before the financial crisis and the housing market breakdown, a meltdown, religious investors were asking payday lenders, does this make sense? Or asking big financial institutions about the nature of their mortgage lending. And lo and behold, we saw what happened when all of the problems with this percolated through the financial markets. Early warning sign for companies, something for them to learn from. Dan Bross, who's the head of sustainability at Microsoft, says that Microsoft always responds to investor requests and really pays attention because they think they can use it as an opportunity to learn. And I think a lot of other companies feel that way too. It's not all us and them. And the other point, I think, is companies are not monolithic. I have heard sustainability directors from companies saying that they really welcome investor pressure because that then gives them ammunition to pursue what they are interested in expanding, which is sort of greater environmental impact management at the companies, which is why they started that themselves.
We've only got a few minutes left, so to wrap up, I wanted to ask you guys kind of a two-part question. One is we've been talking a lot about the ripple-out effect within an industry or a sector, when it comes to proxy voting and the results of that. I was wondering if you guys could each talk a little bit about when we've seen a change that's been driven by shareholder resolutions kind of ripple out and impact our society or politics at large. And then related to that, how endowments can use engagement as an opportunity to address an issue of concern on campus, such as gender inequality or diversity, and any ways that it can provide educational value to their students to do so.
Sonal, the first question was a really complicated question. I'm not sure I have a great example for that one right now, but one thing I think we've had a lot of success with at the Nathan Cummings Foundation and that I wish was still in existence was the partnership that we had with the Harvard Law School Shareholder Rights Project, which actually partnered with institutional investors, including the Nathan Cummings Foundation, to file shareholder proposals at a number of companies. They were wildly successful. They essentially wrapped up their operations because they succeeded in getting annual elections at all of the companies that were lacking them in the S&P. There were a few exceptions, but they were really successful. It was a really great project and a really great way for us to really amplify our impact without having a lot of additional work that we had to do on our end. So I would love to see that project replicated somewhere. And I think, it was a great learning opportunity for the people that were involved with that project as well.
This is Heidi. Sorry about that phone call. That was me. I would say the issue of impact that I have seen a great societal impact is LGBT rights. There was a big campaign starting quite a number of years ago to get corporate America to adopt gay-friendly policies. These resolutions initially didn't get very much support. The support increased over time. Gradually, companies started adopting gay-friendly policies. And I think, arguably, this has been a huge success because as this has become commonplace in corporate America, not only for sort of sexual orientation, but also gender identity, it has then become it's changed in sync with society at large really quickly, and corporate policies and positions with respect to gay rights really played out in some of the Supreme Court decisions, as we've seen, and also more recently in some of the backlash laws that we've seen in, say, North Carolina, where companies said, we're just not going to do business because we don't see it makes sense to do business in a place where our employees' rights are not respected. And so I think that is a really potent example of impact. It's not just shareholder resolutions, but it's shareholder resolutions and investor activism, helping to change corporate policy, along with a lot of other stuff, which has a ripple effect that that Sonal is talking about.
Great. Well, thank you both so much for this. We really appreciate all of your insights, and thanks for everybody who's been on the call. We will send some of this information around. I hope that this was very helpful and informative for everybody who participated.